Would you, I don't know if you saw the show with Stephen last week.
Yes, I did see it, yeah.
Would you agree in general with his sentiment about costs being very high and the numbers that he was talking there?
Absolutely, absolutely. I think in general, agree wholeheartedly. Obviously, there's a couple of nuances here and there that might need a little bit further attention, but in general, the costs traditionally have been very, very high, and I think that's why I know he mentioned Rob Risconi, who was somebody who, painted the retirement market or the retirement annuity market with a big brush, and I think since then a lot has happened. Can more still happen? Absolutely. But by and large, costs still remain a bit of an issue.
Because just before we started the show, excuse me, we were chatting off air, and I was quite honestly very scared by what I heard last week, and because if you didn't see the show, one of the things that came out there was that we don't really know. You're putting money into a retirement annuity. You don't really know where that is being invested and what your risk profile is in that particular annuity unless you're sitting down with your financial advisor or manager or whoever he is and getting those facts out of them. And so often we don't. We presume that everything's all right and you don't really know. I would, as I alluded to last week with Stephen, I would rather do what I do with my cardiologist who charges me a fortune every year. But I go in and I see him and I'm willing to pay that fortune because I need that advice and I need him to say, yeah, you're all right. Or, no, you're not. We need to do something. And I'd like to do that financially as well.
And I think that's a reality these days. It is starting to become more and more of a thing where you do have professional service providers available. I mean, I know Stephen said that he doesn't deal with intermediaries, and for good reason. I mean, currently there's somewhere in the region of 180,000 agents or representatives that are registered with Financial Services Board, and these are the ones that are going out and selling products under the auspice that they're giving advice. What you have to then break that down further is to start saying, well, who are those that are out there that are professionally qualified and have the experience and are in a position to charge you a fee for that advice? So not charge you to sell you a product at the end of the day, it's charge you to give advice and then be accountable to that advice. But like I said, it's by the minority. I think if you have a look at it, if we take the financial planning industry as a whole, there's currently about 7,000 people with the Financial Planning Institute out of 180,000. Half of those have got what's called a CFP designation, which is the highest designation for financial planning, and then half of that again are actually practicing. So you're looking at about 2,000 people, which is promising, but it needs to be more. And those are the individuals that you can go to and start saying, well, give me advice, not just on my retirement funds and not just on my investments, but have a look at everything from estate planning to risk planning, etc., and bring it all together for me, and that's important.
What do you guys do?
That's pretty much the space that we play in. Right. So we're a fee-based practice, and basically we sit down with clients and we give advice. And then it's dependent on how much of that relationship we then want to partner with, or the client then wants to partner with us. Some of them would sit down, we'd do a full plan, full analysis, and we'd identify all the good areas and all the bad areas as an example, identify remedies for those, and really if they want us to provide that, we can provide it. Alternatively, they can actually move out and go and do it themselves if they would like to.
Do you find that, okay, let me put it differently, what sort of percentage of people who come to you for that sort of advice go away and actually do it on their own?
10%, if that.
Yeah, because we don't have the knowledge. I think it's also a fear, because this is not in most people. I mean, you're in the industry. Most people who watch this show aren't in the industry, and we guys, help me out, and girls, we don't know these things, and we get scared about it.
Absolutely. And Jeremy, I mean, the sort of knowledge is the one side of it. Again, the time is the other side. You know, do you have the time, and what is the opportunity cost of that time? At the end of the day, whatever we or any other professional service provider starts charging, they have to provide value for that, and they have to make sure that whatever they are charging, the client is actually getting a reward for that. And the other side of it, of course, is legislation is continually changing. Every time there's a budget speech, every time we get to September, October, November, there's tax law amendments. Everything has a ripple effect that runs not only through your investments and your retirement vehicles, but onto things like estate planning as well. So you have to constantly keep updating that and making sure that you're on top of it all the time.
What are the structures that we should be looking at and being, or the vehicles that we should be in?
Well, if you look at, I think there's two groups that we can broadly categorize investments into. The one are the retirement funds. Okay, and you dealt a little bit with it last week, and that was retirement annuities, pension funds, provident funds, right the way through to something like a living annuity, which is post-retirement, where you draw an income out of. The other side is what we'd call discretionary or voluntary. And that's where, if you had an online share trading account, that would be there. If you have unit trusts, if you have an endowment from the life company, those are the ones that start coming to play on the discretionary side. Okay. Now, the important thing for me is, as we spoke about costs briefly in the beginning, so too a cost that must be considered is tax. And that's the difference between these vehicles, is how they're treated from a tax perspective.
Well,
so forget products, it's tax.
It's a fairly high cost, isn't it?
It can be really, really significant. You know, so if we're talking about 1 or 2% here or there in terms of asset management costs or whatever the case may be, we could be talking about mistakes or missed opportunities of anywhere between 20 and 40% of those values, which is a massive, massive number.
Okay, so how do you then start limiting that area of possible, because it's a future cost that you're looking at, isn't it?
Some of them future costs, some of them are immediate. Okay. So if I had to look at it, the first place to start is, of course, most people want to try and secure the retirement. So I said, we'll start with your retirement fund side. What do we want to ensure from a tax perspective on your retirement fund side? You want to make sure that you are putting away the maximum that you can from a deductibility point of view from SARS.
What is the maximum you can put away at the moment? At
the moment, I mean, there's really 3 levels. If you're looking at, there's 3 levels from a retirement annuity perspective. Okay. The most commonly when we look at retirement annuities, because they're either commissioned or owners of businesses, you're going to have 15% of your income can then go into retirement annuity.
It's gross.
Okay. That's gross, yeah. Bearing in mind, you've got to consider medical aids and things like that are going to come off. But by and large, if you stick to 15%, you're pretty close to the number there. Looking at pension and provident funds, from a practical point of view, SARS will allow you to go all the way up to 20%. Okay. So it becomes, like I said, a practical, and it depends on how your pension fund is actually treating it. That, of course, is again, like I said, subject to change. So 1st of March next year, we're probably going to be seeing that 15% of what they called non-retirement funding income increasing to 22.5% of taxable income. And that doesn't matter whether you've got a pension fund or an RA or a combination. So it's going to become a lot more flexible and easy for individuals to start choosing where and how. They might say, well, I want the minimum into my pension fund and I want the rest to go into a retirement annuity where it can be managed on a passive or active or on my own basis.
If you're an individual like me who doesn't work for a company and doesn't have a pension fund but rather invests in retirement annuities and those sort of things, would I then be able to go up to 22.5%?
As of next year, 22.5% of your taxable income. So any other deductions like car allowances or whatever you're paying yourself would have to come up first, but 22.5 is what they're looking at currently.
Okay, now so we're now dealing with your tax liability in the present. Are there any other things that you can do legally? Because we've always said on this show, you do not mess with SARS ever. No. Because they'll come and they will capture you. Sure.
Look, for the rest, in terms of right now, what you then got to start having a look at and saying, if I've got discretionary money, so outside of that, if I've got discretionary money, where and how do I want to invest it?
Now when you say discretionary money, you're talking to me, you mean extra money?
Extra money. So you want to save. You want to save for something specific or just to build up a nest egg for yourself or an emergency fund, whatever the case may be. Again, a big legacy issue in the industry is people were sold endowments. Okay, for 2 reasons. One, they got good commission on it. And then the second one was if you go 10 years back, all right, the interest exemptions, so how much interest you're allowed to earn before you start getting taxed, was very low, and the interest rate was very high. So an endowment became quite a nice vehicle because it's taxed at a lower rate. Okay. Now what we've seen is the interest exemptions have become much higher, and interest rates have gone right down. So if you take the average person who, let's say, has a spread of asset classes or spread of assets, okay, in a discretionary fund, a voluntary type thing called a unit trust would be a good example, and they could go up to R1 million before they attract any tax from an interest perspective. Now, a lot of people are sitting in that very situation, except they're in an endowment. An endowment is going to tax it at a lower rate, but from Rand 1. Okay, so if I've got R1 million, I'm going to get taxed 30% on any interest that I earn from Rand 1. Okay, it becomes a little bit complex, but at the end of the day, what's important is most people should rather have that unit trust type structure.
So hang on, I'm just trying to work this out here. You see,
So I
couldn't even work it out on a calculator, man.
if I've got a unit trust,
Yeah.
I've got 30% exposure to fixed interest,
Right.
okay, and it's doing about 7% as an example. I pay no tax on my interest. I've got R1 million.
Okay.
If it was wrapped in an endowment, that 30%, in other words 300,000, okay, would attract that same 7%, so it'll be 21,000. However, now that 21,000 is going to be taxed at a flat rate of 30% from Rand 1, so I've got a 7,000 Rand a year problem. So what does that equate to? 0.7%. But that's only one aspect that
Yeah.
we've looked at.
So, in other words, if I had took out an endowment 15 years ago, I should be looking at trying to get out of that.
Quite possibly, yes. Yeah. Remembering not one's better than the other. Okay, and this is where we then have to say, for some people, if they've already got to that maximum interest exemption, then endowments start making sense. And this is where that structuring becomes incredibly important, to say, how do I make sure that my portfolio is as efficient as possible? And when we talk about portfolio efficiency, costs is a big one, tax is another big one, and we've got to get those two right.
Let's come back to portfolio efficiency. Never, ever, ever thought I would use those words in my career. Portfolio efficiency.